Hi, I'm Peter Rose, founder of Longwood Currency Trading. Don't trade Forex for the runner. What's a runner? A runner is a trade that you have put on a position that's gone beyond where you had set your initial profit target, and it's running beyond that. That's what it is. Now, again, we're talking about day trading here where your profit targets are 20 to maybe 30 pips away. Why limit that? Well, if you're going to trade for an hour or 2 hours a day down on the 5 minute, you've got 12 trading opportunities or trade decisions or position management decisions, 12 of those an hour on the 5 minute chart that you can make. So there's plenty of opportunity there for you to get into a position, let it run to its profit target or as much as you can get out of it, and then close it out and you're done for the day. That's how I think most folks that are interested in what I do are looking to do. You're working a job, or you have other things that you're doing, or you're retired and you're busy traveling or whatever, and you don't want to spend more than an hour or 2 hours a day actually trading. And so we can accomplish that very well on the 5 minute chart. Well, I mean, I've been doing it fine for years and years and years. The amount of money that you make is not based on how many pips you can gain anyway. It's based on the amount of pips that you can consistently gain with a lot of money behind it. But that's not the point of the story. Why don't you trade for a runner? Why not always, when you're in your trading, when you're setting up your profit target at that 20 to 30 pip point, why don't you go, but if it goes through that, then it could get to 50 pips. Ask yourself a question. What's the likelihood that you're going to be able to have that price run 50 pips? When normally, after about 15, maybe you get to 20, there's some sort of a retracement. On the 5 minute chart, with about a 5 period ATR, trading a major. Those are the constraints that I teach under, because those are, that's your baseline. If you're trading crosses, exotics, you're trading 500 to 1, all this other kind of stuff, nothing I say is going to be of help to you, because that's not trading. That's just rolling the dice and gambling. And so when we're doing our entry analysis, the runner, the possibility of that price going beyond the profit target is not part of the factoring in of the calculations. You don't go beyond where the price, the profit target is. If you thought the price was going to run to 50 pips, then that's where your profit target is. But you better not be trading on a 5 minute chart. You ought to be on a 1 hour chart or something, or maybe you could do it on a 15 minute. Remember, on a lot of the major pairs, your daily ATR is 80 to 100 pips. So if you're thinking your profit target in one swoop to the 50 pip level in an hour or 2 hour period of time, that's what you're shooting for, you're going to be waiting a long time, and you're going to take a lot of losses trying to stretch it to that point. You don't plan your trades for the runner. But you have to have the skill and the knowledge to take advantage of them. For example, and the only reason I'm sitting here in front of my wood stove, it's early March of 2024, and you'd say, well, why are you in a flannel shirt sitting in front of a wood stove in early March? Well, I'm in New England, on top of a little mountain. That's where we live, in a rural area. And what we have to do is plan for what's going to happen all the time, but make sure, I mean, as our daily living stuff, but when we do something, we have to do it with a longer term view. So the reason I'm sitting in here is because I just came from outside and looking at the storm that has just blown through here, rain and sleet and stuff, And I'll run that video now and then explain it to you, when I come back. Well, okay, what did that represent? Well, those of you who have followed me know that last summer we had a tremendous storm, and a lot of the roads around here had been washed out. And my little brook and culvert thing, I've got a brook and it runs through a culvert underneath the backyard, which is that mud area that you saw. That culvert got all full of sand and logs and stuff from the water just gushed out of that down the mountain and screwed up that whole drainage pipe and culvert system. And so we had to have a crew come in with a front loader, dig up where all that dirt was, and lay in a new culvert system and lay drainage pipe underneath the ground, so that what we looked at first was the water coming out off the brook and going into the culvert, and that was really rushing. There was a lot of water pressure coming down. You could hear that, you could see the water coming down. I didn't get any closer because it was so strong that all the ground in front of me was flooded. It flooded over. And the second part of that was the end of the drain pipe where the water was coming out, and you could see it's really coming out. Well, that pipe was put in bigger than the older one in order to handle events like this, so that we wouldn't plug up the pipe or flood the whole entire backyard. Storms aren't going to get bad enough on a storm-by-storm basis to require that size of piping. To go to the next size piping up, I might as well be constructing drainage around an landing strip on an airport. We looked at the fact that we'll get every now and then these enormous runoffs, which is what we're having right now. We've had 3 days of rain, and I'm about a third of a mile down from the top of a mountain. It's kind of a gentle crest, and then when it gets just past my house, it drops off very quickly. So there's a lot of gravitational pull to all the water that's coming down the mountain to go through us and around us and into my culvert situation. So that culvert was put in there not to deal with the normal storms. The water runs through there, it gurgles, it's very pretty, but it takes care of it. That culvert was put in the event that we got a major flood warning storm, which the Weather Bureau came out and said this whole area is under flood watch. In the event that happens, that culvert and the piping would be large enough to get the water away so that we didn't have water all over the yard and flood the basement and all that other stuff, which is what's happening today. The reason the yard is still torn up with all the mud is because all that stuff was just put in at the fall of last year. Actually, right before it snowed, we were fortunate to get all that in, and then the ground froze and it snowed over. So the landscape crew is going to come back, and we'll do the landscaping later this summer. The point of all that is that event that we're looking at today is the runner. In the long term, we've planned for that. Everything is taken care of, because if we wouldn't have changed that, that whole yard would be a swimming pool right now, and I'd be 2 inches of water in the basement. So that's mitigated that. But all the storms that have happened and the snow melt that's gone off, I mean, there was a period of 3 or 4 days we lost 8 inches of snow through warming and melting and all that stuff. So that's a lot of water that's coming around and coming down the hills. We've had many rainstorms making that transition between winter and spring here that have put the test to that new drainage system. So we haven't had a runner all the way through from last fall until today, and now we've got a runner. So when we're looking at our trade analysis, our entry analysis, you don't consider the runner because that's already supposedly built into your trading plan. What am I going to do if I get a runner? That's a whole separate issue. You don't do analysis for what ifs. You only do analysis for what should be. You try to be within a standard, you might go out 2 standard deviations of what norm is and build your rules and your actual entry analysis and position management rules to deal with that 88% or whatever it is of the likely price action. The other is taken care of in your business plan, your trading plan, which says, oh, by the way, if you get a runner, you probably ought to have a rule as to when you'd stop out of that, how you'd stop out. Do you want to come out gradually? Do you want to take maybe half off? And if it keeps on coming, take the other half off. What's your plan for that? Because at some point, the runner's going to turn around and come back against you. Do you want to run a short stop against it, or do you want to stage out like I was just talking about? That isn't part of your entry analysis, and it shouldn't be part of, oh, here's the problem, I'm in position management now, and all of a sudden I got a runner. That's not the time to try to solve the problems of a runner in real time, because you really can't write the rules for that, because you don't know what that runner could be like. I had a runner a few non-farm payroll events ago. The thing ran negatively against me 40 pips, turned around and ran 40 pips back down and 30 pips in my favor, and I cashed out and I made $5 grand. So that wasn't part of my analysis or whatever. My analysis was I was just going to go in for a short chop and get out. It was non-farm payroll. I'm just looking to grab 5 or 6 pips. But there was such a boomerang that it turned into a runner. And as it ran, I doubled my position. In any event, things that are far out on the distribution curve of possibility of happening need to be dealt with separately than you deal with your normal trading process, what the position is normally going to go through. You're normally going to have an entry. So you do that, and those rules are based on a profit target in a lot of example cases that I give, because I'm on the 5-minute chart with a 5-period ATR, or about that. I'm looking for a profit target of 20 to 30 pips, and I'm trying to get at least 15 of those out. Well, you're leaving a lot of money on the table. If I can get 15, I'm going to short stop that thing, and more often than not, I'll get taken out. Because the probability, the statistics say going beyond 15 pips of a clean run under high momentum is going to cause the necessity for a retracement. And there's a specific reason why that happens in the currency markets and not in the stock markets. Currency market is different because it's based on a different premise. In any event, that's all part of a course or a mentoring, and you have to spend time to get used to learning stuff like that or understanding the mechanics of it. But you just look at your chart and your own trading experience if you've been trading on that 5-minute chart. How many times does it go 15 pips and then goes to 20 and then goes to 30? It'll go to 15 pips. If you get the right entry, you should get the 15 pips. And now it starts to go a little bit further, and many times, maybe 70% of the time, if you've done your entry analysis right, you'll tag up at your profit target. But more often than not, 30 or 40% of the time, you're going to get to that 12 or 18 pip level, and then you're going to see price start to weaken a little bit, and you just go, man, now it's 50-50 jump ball as to whether the price is going to continue in the direction I wanted it to, say you're long, and having a retracement of 5 or 10 pips. Well, once you get a retracement of any size, how do you know it's going to be 5 or 10 pips? Oh, from a probabilistic standpoint over the blah, 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 I know it's only going to come back 8 pips. Okay, what if it comes back 12? And you only had 15 that got tagged, and now it's back 12, and you're 2 pips short of a break even, thinking, oh, I had that right, I'll just hang on to it. Instead of stopping out where you should, which is your entry point so that you're a wash trade, you're going to hang that, and that trade all of a sudden becomes a 10 or 20 pip loser because you have invested yourself into this position analysis that you did, that the price should get to here, and now this is just a minor retracement, and you'll get stuck with a 10 or 20 pip retracement. And the chances are, because you didn't write your rules the right way, you won't go out at 10 or 20 pips negative. You'll let that thing go. And as experienced as I am, I do my analysis very quickly because I want to get in there and I want to get out. When the thing goes against me, I go, well, that's strange. I'm really good. I have a daily win rate of 80%. 80% of the daily trades that I make on a daily basis, I win 80% of the time. So if I trade 10 days in a row, I'm going to win 8 of those days. Okay? So that is a bad conviction to have, because I go, oh, well, it'll come back because my entry analysis is really good, so that I'm winning on a daily basis. If it takes me out, if it goes 30 or 40 pips against me, it'll turn around. And if it doesn't turn around, and I get out there 40 pips, I can make that back in a couple of days. Well, now a couple of days of your work is going to make up the loss, instead of compounding 2 more winning days onto your schedule. So that if you're not winning 80% of your days, you might be winning 55 or 60% of your days. Now, how long is it going to take you to get back to even before you took that 40 pip loss? And I unfortunately have had a tendency to let that thing go 100 pips. But you just get married to it. You really do. So I've switched from trying to make those decisions in a real-time basis to like a project plan rule, an overriding rule that you'll do this. Now, some traders you'll hear, gee, if I go negative 2% on any given trade, I just cut it and go. If the 20 pip, I hope it's going to turn around at, doesn't work, I'm out at 25 pips. You have to have those, what we call panic outs, if you're going to do that. But those panic outs, the important point of this video is those panic outs do not belong in your trading rules for your entry analysis, your position management, or your exit methodology. Those are the 3 problems in the life cycle of a currency position that we need to solve and develop rules for. That's why I always say I have 3 rules. They're very simple. Each rule has 3 or 4 conditions that need to be met in order for that rule to happen. And it makes my life very easy. It's all solved. All I have to do is have enough confidence and a good enough set of metrics that I can ride out the rough times. For example, that everybody criticizes me for setting an 8 pip or 10 pip stop. Oh, that's not enough time to give the price room to breathe. Well, for the number of times that I may lose, if you're a 60-40 trade, you're going to lose 4 times. Why wouldn't I rather lose 8 pips 4 times rather than 20 pips 4 times? Why wouldn't I want to do that? Or if I run into the proverbial 6 losses in a row, which within 300 trades, you're going to hit that for sure, absolutely for sure you're going to hit that. in less trades than that, there's a high probability that you would hit it even within 100 trades, that you'll hit 6 losers in a row. Well, I'll hit 6 winners in a row too. Yeah, but do you want those 6 winners to make up for all the crappy, shitty 6 losers in a row, where you could have clipped it at 4 pips, and, clipped it at 8 pips, or maybe you want to go out to 10 pips, but instead you feel you need to run it to 20 or 25 pips. I mean, that 10 pip difference is what a great goal would be on a daily basis, just to win 10 pips. I mean, you got to remember, if you're trading a 10 lot, that's $1,000, 10 pips. So what are you doing not understanding where your rules should be? You have to step back from the market, guys, and you have to look at that market and say, where are the problems that I need to deal with on a 2 standard deviation or 1 standard deviation out? I think that's a little short, but 1 or 2 standard deviations out. How do I build my rules to fit that? And then for the outliers, you go to your trading plan to develop those, because those don't change. Your outlier rules, your panic rules, they're not going to change. If I go onto a chart and I say, oh, today I'm going to work my stop on a structural level, and today that's 12 pips, and then tomorrow I look at it and the structure is at 15 pips, so I'll set it at 15 pips. Those are things that you are doing in real time and things that you can do in real time. But looking at this issue of something that goes in your favor and then turns around and goes against you, and then you freeze up, you've got to have an overriding project rule that says, no matter how bad it is, it'll get worse, so just take the loss at that point. I have failed to do that more times than I'd like to imagine, and each time it cost me, one time it cost me 6 figures. So you have it however you want to have it. But those types of rules, as well as the runner, that's an outlier. That's an anomaly. You can't trade for the outlier. You have to trade for your daily bread and butter. And then when the outlier looks like it's going to go, you go up to your project plan for those rules, and you say, oh, well, that includes I should go in a little bit heavier right now because this is going. My likelihood is it's going to go. It's going to continue to go. So I want to load up more lots now early, because at some point it's going to turn around and come back, and I don't want to be adding lots as the thing comes back, because if I add 5 lots after a certain period and it drops back against me 5 pips, I'm $250 out of whatever I accumulated in the time before that. And do I have the discipline to cut that runner? Because you're hoping it's running, it's going to continue. You can't count on that. And so you have to have your protection up into your trading plan, and that has to bolt right on top of your trading rules. And so I have things, I keep them really simple. I've got one rule for a runner, and that's whether it's going in my favor or the runner is going negatively against me. And I have 3 rules that take care of the 2 standard deviations from norm regular daily trading basis. It's got to keep it very, very, very simple and try to take as much of the emotion out of it as you can. I'm in a trade right now. It's way underwater more than it should because I violated that, because I thought. And so now that's a worrisome thing. Instead of trading right now, I'm waiting to see what's going to happen. By the fact of waiting, I could lose another $10,000 or $15,000 and wipe out a couple of months of trading profits. So it's important that you look realistically at your market that you're trading and what the solution sets needs to be for in standard deviation, price action, and outlier. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.